Welcome back everyone. In this video we will study the long straddle. We are still in the context of debt strategies, or where we are mainly option buyers. The long straddle strategy is essentially made of the purchase of calls and the purchase of puts at equal strikes and in equal quantities, and in this case at the ATM, that is, the exact point where the price of the underlying is beating. With the price of the underlying at 1,000, we simulated the simultaneous purchase of a put and a call at strike 1,000, which both cost us $40 each. The total of our cost is therefore $80. Let's focus on the dark payoff at expiration date. What does this strategy involve? Yes, we are able to play in both directions. But to play on both directions and still be profitable, we need a strong move in the underlying price. We can make money whether the market goes up or the market goes down. And this precisely because of the asymmetry of the risk profile of the options. The purchased call cannot lose more than $40, while the put can profit until the underlying reaches zero. Correspondingly, the put cannot lose more than $40, while the call has room for an infinite growth. So if the movement is strong enough, the gain on one option will compensate and then exceed the loss on the other option. 40 plus 40 equals 80. And in fact the break-even points are just 920 down and 1080 up. The maximum loss, at expiration date, is exactly in correspondence with the long strikes, that is if the price remains still, the strike 1,000. As we see, if the underlying moves just 50 points, up or down, our loss at expiration date decreases considerably, from $80 to just $30. Now, let's look at the orange curve of the at now. As you know, this is the line of our real risk profile and the pricing of options at this very moment. As time passes and expiration approaches, the curve will tend to go down day by day. Let's specify better, since this strategy is best to show. If tomorrow the underlying remains at 1,000 and volatility does not change, the price of the call and put will not be $40, but $39.50, we will therefore have lost $1. As we know, the time influences the prices of the options, and the closer we get to expiration, the more the daily loss will increase more than proportionally. In fact, at 40 days from expiration, each option loses 50 cents, at 20 days from expiration, 70 cents per day, 10 days from expiration, $1 per day. At 10 days from expiration, both options will cost $20 each, making us lose $40, that is 50% of the capital put at risk. And consequently, we will expect the at now line drop. So, who wants to open a strategy like this one? Everyone who has an expectation of an increase in volatility. What matters to us is that the market moves quickly and deeply, no matter the direction. For example, on an American stock, before the announcement of quarterly earnings, or before an intervention or a speech by a governor of a central bank. Well, in any case we expect a strong movement in the underlying price. The main advantage of this position is that the risk is limited to the premium we paid, and theoretically we have unlimited profit. The disadvantage is the overall cost of the premiums required to enter the market because we are buying two options, and if there is no strong directional movement, it is very likely that all or part of the premium will be lost. But as we know, the options allow different possibilities of risk management. Let's take one step further. Is it possible to reduce the premium paid, which represents our cost for opening the position? Is it possible to put a little less money in the pot and still play in both directions? Barring extreme events, the underlying is unlikely to hit 0 or 2,000. Sure. To reduce costs, we can finance ourselves by selling options at more distant strikes and with smaller deltas. This creates a figure that, in the face of a lower cost, no longer allows unlimited gains, but limited by a take profit, which is the strike of the short option. However, by collecting the premium of the options sold, it is possible to significantly reduce the cost of the options purchased. Let me explain that. Let's go back to our long straddle that we paid $80. We want to reduce its cost so we can sell a put and a call option further away. In jargon we say OTM, and we collect their premium. In addition to buying a call and a put at 1,000, we sell a put at strike 900, collecting a premium of $13, and at the same time we sell a call at strike 1100, collecting $8. 13 plus 8 equals 21. $21 is the premium that we have collected. This premium allows us to reduce the total cost of 80. So, we limit our theoretically maximum profit, but we can maintain the same overall risk profile. We will no longer spend $80 but $59, and we still have the chance to profit in both directions for a maximum of $40. The technical term of this strategy is reverse butterfly. Thanks for watching, see you in next video.